Good morning, everyone. Welcome to our third quarter Tesla preview and our 2022 outlook and the reasoning behind our $1,200 price target on Tesla. Joining me today is David Kalis. He's my partner. He's a founding member of the Future Fund. He's a portfolio manager here. Together we have about 55 years of experience managing money. He's going to moderate the Q&A and after my opening remarks, which will probably take about 30 minutes, and we'll probably leave about 20 minutes for Q&A. And if this is successful, hopefully we can do this again. If you want to ask a question, just type it into your PC or your phone, and we'll try to get to as many as we can. So let's start. First part, I want to talk about Tesla third quarter. As you know, they're going to report tomorrow. Everybody expects them to beat. Obviously, the stock is up about 11% since they announced volumes back on the 2nd. Nasdaq's up about 5 or 6. So just think about it's 5 or 6% relative. That's still, I'd call it a run up into earnings. We're at $1.75 non-GAAP EPS. That's before about a nickel Bitcoin charge, another impairment charge. We can go through that in a minute. I'm not going to go through too much detail. A lot of people have already done the detail on each of the different pieces that go in. I really want to talk more about how the street's going to react to earnings afterward. And that's, if you want to see some of our models, you can look on our Twitter feed. You can look on the Future Fund Twitter feed. You'll see the models that we're using. But I'm just really going to go through some numbers quickly, but I want to talk more about implications. Tesla IR compiles a survey every quarter. They're at $1.69 for third quarter. That's non-GAAP. Bloomberg's at about $1.67. So again, if they committed at $1.75 before any Bitcoin charge, that's a beat. I think if you really want to see the stock move, it's got to do much better than that. Other key numbers that we're watching: auto gross margin x ZEV credits is a big number. There's a lot of, I don't say concern about it, but just, you know, people are saying, look, they had to expedite a lot of parts in, a lot of chips in. So we're looking for a number of about 26.7. The street's at 26. Last quarter was 25.8, but that's a big swing factor if they miss or if they beat. The other key number we're looking at is average selling price. We're looking for a little bit of an increase from second quarter. We're looking for 50.2x the EV credits. That's up from about 49.8 second quarter. And just so you know our assumptions there, we've taken about half the pricing that's been taken since April. As you know, Model 3, the pricing's up about 11% on the short range. It's up about 8% on the Model Y. We're taking about half of that. Remember that during the last quarter, they guided that about half would go into the third quarter, half would go into the fourth quarter. Meaning, if somebody delivered an EV back in, June or July, back in April, they would have only, they might not get it until fourth quarter, given that the delivery wait is pretty long. So that's why we only bake in about half of the pricing into third quarter, half goes into fourth quarter. The other assumption that's important is the FSD take rate. It's been dropping over the years. We believe that because of the $199 monthly subscription rate, that's caused it to drop another 3 or 4 points. A lot of people are just trying FSD. They want to make sure they like it before they buy it. But that's a negative on the P&L. It's a negative on average selling price, because instead of booking half of the $10,000 up front, you're basically booking 3 months at $199. Reg credits, we're assuming about 320 million, which is down from, I think, 354 in the second quarter. We're assuming higher SG&A to prep for Berlin and Austin opening. There was about 45 million of hedging gains in the second quarter. We don't expect that to repeat. I mean, they may, but we're just not assuming it. We're assuming zero. Interest expense should drop. They retired about $1.8 billion of debt in the quarter, so our interest expense is down about 16 million from second quarter. And the tax rate, we're assuming 15%. It was pretty low in the second quarter, it was 8.9. We expect kind of a normal tax rate. In the U.S., Tesla doesn't pay taxes because they have tax loss carry forwards. China's about 15%. Europe's a higher tax rate than that. Bitcoin impairment, we're assuming a $60 million charge. We get that by looking at the, I think the way Tesla does it, they look at a 24-hour rolling average of what Bitcoin's price is. Back on July 20th, it got down as low as about 29.8. Their carrying value, if you look at the second quarter 10Q, is about 31.3. They own about 42,000 Bitcoins. Take 42,000 times 31.3 less 29.8, you get about 60 million as a Bitcoin charge. And as I've said before, nobody cares. People will back that out. It will go into the earnings. They don't get to adjust it for non-GAAP earnings, but most people, it's worth a nickel, will probably back it out. So it's not really that important in the grand scheme of things. The other thing people are going to be trying to get clues for is where's the fiscal year 21 ending December 31st end. Interestingly, when I looked at the IR survey, which came out yesterday, it looks like the street's up to about 590. And, according to Bloomberg and FactSet, those numbers are much lower. I've been at 590, and it's like deja vu for me. We'll talk about this in a minute. Every year I seem to start about 30-40% higher than the street. And we have that for 2022, and then the street catches up. And it's funny that here we are going into third quarter and the street's at 590 and I'm at 590. So how does the market react to this? As I said, for the last 3 weeks or so since volumes came out, Tesla's been on, I would say it's been on fire, but it's gone up pretty nicely. It's up 11% since volume day. If you look at the last 6 quarters, 5 of those 6 quarters, Tesla's actually fallen on the day after earnings. The market's implying about a 5% move one way or another. But you look at the day after, on average, it falls about 2.7% over those 6 quarters. And if you go out 5 days after, on average, it's down about 2%. So if I'm a long-term holder, I'm not doing anything. I don't even think it's worth it to hedge it for 2%. I think you just kind of wade through it because, ultimately Tesla's a great story. And as I'll talk about in a minute, the fundamentals are very strong. And I don't think 2% is really worth, getting too worked up about. So just be aware of it. I do expect a wave, and I'll call it a wave, of earnings estimate increases and price target increases following the quarter. What the street tends to do, you might ask, well, why don't they just do it in front of the quarter? They don't do that. It makes it look foolish this close to the quarter. But what you see is that after earnings, they use this as a reason to take their price target up. And so I assume that, come Thursday morning, assuming a good beat, you'll see some of the buys take their price target up, and without going through names of Morgan Stanley, Goldman, Baird, Deutsche, New Street, they're all kind of in the 850, 900 range, which is where the stock price is. You kind of look foolish if you're telling your clients to buy a stock with a price target of 900. So my guess is you'll see some price target increases up to 1,000 or more, and you will see estimate increases up to at least $6 probably for this year. And for next year, we're going to talk about that in a minute. Okay. So let me see. One other thing worth thinking about, which it's kind of an unimportant thing, but it makes headlines. There are 2 balance sheet items that the company could take this quarter or next quarter. One is the deferred tax asset. There's about $2 billion of tax loss carryforwards that the accountants Pricewaterhouse will say, look, you can recognize that once you believe that you're going to be generally profitable going forward. And a lot of the bears use this as a reason to say, well, see, Tesla must not be that confident, or they would have taken that $2 billion DTA recognition. I don't see it that way. Usually these things happen at the end of the year. I would expect you'll see it in the fourth quarter or maybe early next year, but I don't see that happening this quarter. The other big asset item is the FSD balance, which again, when you give $10,000 in, 50% of it recognizes immediately. The other 50% gets put on the balance sheet. And because we're still in FSD beta as of the end of September, I don't think that the auditors will allow them to take that $1 billion or so. But together, that's $3 billion. It's not a cash flow item, but what it does do is increases their book value of equity. And when the credit rating agencies are trying to decide whether to improve Tesla's credit rating, that becomes an important part. So we're going to come back to that in a minute. Okay, let's move on to 2022. I've said this before. I think 2019 going into 20 is very similar to me. 2019 going into 20 is the same as 2021, 2022. Back in 2019, third quarter was the spark that caused the stock to start really moving higher. It was after a period of underperformance. Those who invested back in 19 remember it well. And then third quarter came and they blew the numbers away, and everybody realized they were going to be profitable pretty soon. And the stock started rising pretty aggressively. 2020, we know what happened. Um, Shanghai opened early, doubled the capacity. Model Y was launched. Again, a lot of the bears kept looking at Model Y as being just a big Model 3. Those of us who were smart enough knew that it was a way to get them in a whole new category, the exploding CUV segment, which is about 40% of the US market, about 45% of Europe and China. And it quickly became Tesla's best-selling EV. And again, the bears never really kind of picked up on that, but you got those two same things happening all over again. You got a doubling of capacity here as we open up Berlin and Austin. So we'll go from about a 1.1 million capacity to about 2.1 once both of those come online, and that should be, fully by next year this time. And then you've got a couple TAM events, nothing as big as Model Y in the US, but you got Model Y going to Europe, which again, the CUV segment's about 40%. So you're literally going from about 25% TAM to about 65% TAM in Europe. And then Cybertruck. Cybertruck is interesting because they keep delaying it. Not 100% sure why, other than, you have to conserve chips. But Cybertruck has about 2 million pre-orders. And even in my numbers, and we'll go through them in a minute for 2022, I've got about 50,000 for next year because they've guided that they won't start making them and deliver them until the end of next year. But that is huge, and it expands the TAM. Today, the TAM is at about 65%, including CUVs. Then it'll be up to about 85%. The remaining TAM is things like vans and subcompacts. So once they launch the Tesla Q or compact, whatever it's going to be, that'll get the TAM up closer to 100%. But the pickup business is huge. It's been the most profitable part of the market. Rivian's got about a 1-year head start on them. Rivian's already being delivered. The F-150 EV will come out mid next year, so they'll be ahead of them as well. But I think that's it's very similar to Model Y in 2020. The other big positives, so doubling capacity, Cybertruck, TAM expansion through Model Y in Europe. The EV credit is still very alive. My best thinking at this point, it'll be part of an infrastructure bill that'll be much more scaled down because you got to get the more conservative Democrats to back it in the Senate. My guess it'll be a $2 trillion infrastructure. So they're going to look for ways to cut that cost down. So I'm still thinking, it'll probably be about an $8,000 EV credit, not 12.5. There's so much noise about it being, 4,500 being just for unions that I think that's not going to continue to fly. And then the date on that, people are thinking it'll be around December 3rd. That's when the new debt ceiling deadline is. So remember, they pushed the debt ceiling forward to December 3rd. That's probably when you'll finally get another infrastructure bill out, and that's when the EV credit. That's actually good because you don't want too much time to pass where people say, okay, I don't want to take delivery of my EV until January 1st because it won't go into effect till January 1st. So I'm not really that worked up that it's going to the end of the year. Another catalyst, 2022 estimates keep going up, and I'm going to talk about it in a minute, but let me just give you the headline. I'm at $10.10 for next year. The street is at $7.44. That's about 35% increase. And there's all kinds of bears out there to say, well, Tesla's all hype and momentum. It's not. It's earnings revision. So when earnings go up, that's what pushes the stock price up. That's what happened in 2019, 2020. And you can look at charts on Bloomberg. I'm sure even some of the free software you can see that. But as earnings go up, the stock price goes up. And if you get earnings going from 744, which is where it is today, to my number of 1010, the stock price could go up another 35% from here. And, that's something that we have to watch. So that's a catalyst going into 22. EV adoption continues to move up very sharply, much sharper, much more quick than I had anticipated. We were at about 3% global EV adoption last year. This year we'll wind up somewhere around 5.5. Based on some of the latest numbers I've seen. China's much higher, Germany's much higher. I've got a 5.2% number in my model, which again, people can see it online. I have 8% EV adoption for next year. I think it's gonna be closer to 10. And again, when you start taking your numbers up 25% on EV adoption, it flows through to earnings, assuming Tesla keeps its share. So that's a big catalyst. And in the investment grade credit, I think investment grade credit rating on Tesla. Right now, Tesla's a couple levels below investment grade. I can't see how Moody's and S&P keep them where they are. Already, when you get to the end of third quarter, we're going to be about $7.5 billion of debt, almost $20 billion of cash plus Bitcoin. Okay, so you got 3 times as much cash, almost 2.5 times as much cash as debt. The free cash flow is exploding. It'll be about almost $10 billion next year after CapEx, and I've got about $7 billion of CapEx in my 22 numbers. And again, the way Moody's and S&P work, they bring in the CFO, they go through forecasts, and then they render a verdict. I can't see how they can keep them as junk when you're generating $10 billion of free cash flow. You got 2.5 to 3 times as much cash as debt. The metrics that the rating agencies look at, there's 2 that are big: fixed charge coverage and then total debt to capital. And they don't usually strip out cash because they're afraid the companies are going to squander the cash. But both of those are investment grade at this point. If you look at fixed charge coverage, which would be you take EBIT, you add back interest expense divided by interest expense, it's about 18 times. That's like AA in any other language. That's a huge fixed charge coverage. And total debt to capital, so take the book value of debt, the book value of equity. They should use market, because market value, they could always raise capital. But the book value would be about 20%. That's also investment grade. So I think, why is that good? It lowers interest expense, obviously. It's going to reduce beta. But there are also many mutual funds, not many, like over 50%, but there's a fair chunk of them, particularly in the core category, that can't own something with a below investment grade credit. So that will be helpful. Okay, so those are all the catalysts. Let's just talk now about 2022. I'm at 1010 in earnings. The street is at 744. I'm at deliveries of 1.48 million. The street is at 1.2 right now. And again, when I'm looking at volume growth, okay, we've had about almost 80% volume growth this year. Once we get to the end of the year, I'm looking for another 66% next year to get to 1,480. And I get that by looking at more of a demand function than a supply function. So I'm looking at global SAAR, I'm looking at EV adoption, I'm looking at Tesla's share of EVs, and that's how I get to 148. And again, you can look at it online. I don't know what the street's doing. The street's up 36% in 2022 versus 2021. And again, their number for next year is 1.2 million. Other key assumptions, I have average selling price going down because of China. They have the short range Model Y that they've introduced. I have a flat year over year auto gross margin for 2022 because you got 2 new plants starting up. And I'm not sure how long this, again, we'll call it chip shortage, supply shortage, is going to last. I got the tax rate going up to 20% from 15 this year. I got Cybertrucks not starting till the very end of 2022. I only have 50,000 my forecast. No subcompact until 2023, and I'm still coming up with $10.10. So I think I'm being pretty conservative. And again, every year it seems I'm way above the street at the end of the year, starting the beginning of the year, and then the street catches up. That's what happened this year. Okay, so we're at $870 as of right before this call started when I looked. That's about 86 times 2022. A lot of people say that's expensive. It's not, because you can't look at PEs in a vacuum. You got to look at relative to growth. If you got a stock like Google, which we own, trading at 22 times, but it's growing at 17, 18%, that's pretty cheap too. When you look at something like Apple, which we don't own, it's trading at about 25, 26 times, maybe 27, and it's growing at about 7 or 8. That's an expensive stock to us. And one of the things I think that we're really good at, Dave and I, and we've been doing this for many, many years, is knowing when to get off of a stock, knowing when a stock gets too expensive. People remember that I got off of Tesla briefly when it was at 870 once before, and we got back in at about 600, 620. At some point you've got to get off stocks that have run, and I still think Tesla's got a lot of room to run, and that's why we raised our price target to $1,200 last week. And let me just talk about that for 1 minute, the way price targets work, because there's always a lot of questions about it. I raise my price target when I get new information. If EV adoption goes higher, or the average selling price goes higher, or I realize that Tesla's share is growing instead of we have it being stable, or there's something else that changes the model, and the model is driven by inputs. We will raise our price target, and the reason we went to a $1,200 price target a week ago is because the average selling price we felt that we had in our model, we had it declining, was too low. And so when I put the new average selling prices in, I came up with a higher price target. Okay. Let me just comment one more thing before I talk about my new price target. A lot of people say at 870 billion, I saw this by Tony Sakanaki, who's a friend of mine. I used to work with him. And so I'm not going to say anything bad about Tony because he's a great analyst, but he's a value guy. And so he said, well, if you look at Tesla's market cap at 870, it exceeds all the other auto manufacturers combined. And I sent him an email complaining about that statement. I said, look, you're looking at today's automakers, which is Toyota and GM and Ford and Stellantis. And, as I said, they're the walking dead. They're going to be like Motorola and BlackBerry and, everybody else in the cell phone business that couldn't compete with Apple. And so you really have to include Apple and Google and Amazon and Baidu and probably half of a dozen players that, aren't even there yet. And so I just think that whole type of analysis is crazy. And, I try to correct them. I think it's also just bad hygiene, for lack of a better word, when you're comparing equity value to units. So he made a comment, people made a comment, they have 40% of the market cap at 1% of the units. Well, you would never compare equity to EBITDA or equity to revenue. You would always compare enterprise value. You should do the same thing here. So you should be adding back the debt. That's just a point I want to make. Okay. Let's go to part 3, $1,200 price target. How do we get it? And then we'll wrap this up and open up for questions. I'm assuming that for next year, EV adoption, which is at about 5.2, probably going to 5.5, will be at about 8%. I'm assuming the global SAR is getting closer to the 80 million that we used to have. And I'm assuming that Tesla, and this is an important assumption, this is probably the biggest investment controversy, that even with all these new EV launches coming and being out there today, that Tesla holds its EV share. And the reason I'm pretty confident of that is because they're expanding TAM. They're taking the Model Y to Europe. They're launching Cybertruck. You will see a Tesla compact at some point, a $25,000 car. And I do believe that will allow Tesla to just hold its share. So my forecast or my price target assumes no market share increase from here, no EV share increase. And the reason I delineate is because that's the way portfolio managers talk. Okay, they talk in terms of SAR times EV adoption times EV share. So yeah, anybody could just take the EV adoption times EV share and get the market share and say Tesla's increasing share. But that's not the investment controversy. And you got to talk the language of the people who are going to control the stock. So if you're talking about a portfolio manager at a big institution, that's an important data point to them. So that's why I do it the way I do it. So when I go out to 2025, I'm at 5 million units for Tesla. And I'm basically assuming 80 million of SAR. I'm assuming a 25% EV adoption by then. And you see what's happened in Norway, right? Norway was at 17% 5 years ago. Now it's at 80. Okay, so I'm assuming 25% EV adoption. I'm assuming they hold their current 25% share, give or take. And that gets me to 5 million units. And I've got ASP, basically flattish, auto gross margin going up a little, tax rate going up to 20%. No EV credits. I have no EV credits in my model after 2023. In fact, next year, I've got them going down to about 600 million from 1.5 billion this year. And then I've got them going to 0. And so come 2025, I'm at $34 in EPS. I put a PE on there of about 50. Now that's down from where we are today. Why? Because growth is going to slow. When EV adoption is going from 3 to 5 to 10, you get a lot more growth than when EV adoption is at 25 already and going to 30 to 35. So when I forecast out 10 years and I try to figure out what is the growth rate from 2025 to 2030, I get about 20%. And what is a 20% grower that's investment grade, that has more of a market beta? What type of a PEG ratio can I put on that? It's probably closer to 2.5 that you see on the S&P. Apple's 2.7, Microsoft's 2.7. So if I put a 2.5 on 20%, I get about a 50 PE. 50 times 34 is 1,700. And then here's what I do with the discount rate. A lot of people say my discount rate's too high, too conservative. I look at a 10-year treasury of 2%. I have an equity risk premium of 6. So I look back over it goes back to 1977. We use Empirical Research Partners, great strategy shop if you're interested in getting data back, 50, 60 years. A normal return of equities over bonds, about 6%. And then I apply Tesla's beta of 1.6, which again, it's today, it'll go down over time. If you take 2% risk-free plus 6% equity risk premium times 1.6, that's 11.6%. And then so then I take that 34 times 50 is 1,700, discount back 3.25 years. Why? Because I'm going from the beginning of 2025 back to today, which is October 21. Because a lot of people try to figure out, well, how are you getting your numbers? That's $1,200. Okay. And one sensitivity I've done, people want to know what happens if interest rates go higher. Well, right now I'm using a 2% 10-year, so that's not, to me, I'm not worried about it piercing 2. But let's just suppose you are. And every 10 basis points in a 10-year is worth about 2% to the stock. Okay, that's the math, because you got to use a higher discount rate to discount back, and you got to use a lower terminal PE. Okay, so that's my $1,200. Dave, let's roll up the first question.
All right, thank you, Gary. We have a number of questions. I think I'm going to start to focus a little more on the longer term first. And so when you think about the bear case for Tesla, the number one thing seems to be competition. So you have competition really coming from two areas, I think. One is from the new companies like the Lucid. How are they going to compete with Tesla? And then secondarily, which I think people are more concerned about, are the ICE manufacturers. Anywhere from GM to Ford, they are starting to roll out EVs. Some have been successful, some have been not too successful, but they're clearly putting a lot of capital around EV, battery technology. And you talk about EV adoption. Obviously, the market's going to grow. What percentage is Tesla? So talk a little bit about your feeling about who's going to be successful in competition. Is it a big deal to you? And as you get out a couple of years, what the market for EVs looks like.
Yeah, let me start with the legacy guys. I call them the Walking Dead and Kabuki Theater. I've called it. I feel like they're doing a lot of things for show. It's almost like they're saying they're going to do this, that, and the other thing, but there's just not a lot of action, for lack of a better word. And they have introduced new models. And I think up to now, they've been very careful because they didn't want to cannibalize their ICE business. And now we've seen, probably in the last 12 months, a real big shift in strategy because it's not working. They're not gaining any share. And worse, a lot of their new EVs just have not gotten any traction and have gotten bad reviews and have been recalled, with the exception of Porsche, which has done a pretty good job with Taycan. I think what has changed in the last 6-12 months is they're now deliberately cannibalizing their core franchise. So you see the Ford F-150, which is the best-selling pickup truck of all time, coming out with an EV version. They're going to deliberately cannibalize it. Porsche is bringing out the Macan EV, their best-selling model. And I think that definitely ramps up the competitive pressure. And then, look, you can't start with a brand that doesn't mean anything with consumers. You launch e-tron or you launch ID3 or ID4, it's just not going to get that much traction. But if you launch a Macan EV, you launch an F-150 EV, you're at least going to get your existing customers to buy it. You're not going to lose them. So I think they'll survive. Once they realize that's the only way they can do it, they'll literally convert their whole ICE franchise to EV franchise. That's going to accelerate EV adoption. And at the same time, as you point out, Dave, you continue to see new competitors. I actually think Rivian's going to do a great job. I know a lot of people are making fun of its $80 billion valuation, and I haven't driven in one yet. But I do think it will be successful. I don't know if it's going to get valued at 80 billion, but I think it'll be successful. From what I've seen, they've spared no details. They seem to have a really good PR machine out there. They're advertising. They will gain market share, and they're the first one out. And so I think it'll do very well with the younger crowd, and that's who they're targeting clearly when you look at their commercials, when you look at their social media ads. Lucid, it's hard to know. It's priced too high. And I guess, they started with the Air, whatever, the premium one up at 120 grand. It's hard to afford a $120,000 car. It's why, Model S, Model X are kind of nichey. But once you get down to the $75,000 car, it'll probably be fine. It's gotten good reviews, so I think it'll succeed. And in all the autonomous vehicle players, they're going at it, they're investing in it, they're putting a lot of money into their hardware. They don't have the neural net as vast as Tesla has, but they will be successful because they're putting a lot of money into the hardware. Those folks will be successful as well. So when you add it all up, I think you'll see a lot of new competition that'll be successful. I don't think the legacy competitors will go bankrupt, but I think there'll be a much smaller much smaller share than what they have today going out 5 years. Okay.
The other question that we have, or a number of questions, is about robotaxi and FSD, which is obviously a big topic, especially on the Twitter community. And I know you have not put robotaxi into your estimates at this point. You're not valuing it separately. And I know there's a lot of debate about FSD. And I know you showed some videos, you're driving around, and you have a lot of experience with it. So why don't you take us through your thoughts on why you are or not impressed with FSD, and how you think this will play out with robotaxi, and also comment a little bit on on Google and Waymo and how that all plays out from a robotaxi perspective.
Well, let me be clear. I'm impressed with FSD. I think it's a great product. It's much better than it was, say, a year ago. It's probably almost level 3 autonomy. It's still rated level 2, and that might be for strategic reasons because there's less regulation. But it's getting much better as time passes. And once we get to version 11, Elon has said it'll be a single stack, so you're merging the city driving platform with the highway driving platform. This thing will ramp up in quality very quickly. That said, everybody's investing in autonomy. People have been investing in autonomy for 2 or 3 years, sometimes more. And I guess where I am on how do you translate that to robotaxi? With FSD, I view it as you're going to sell more Teslas. The take rate is 10. It'll probably go higher as we get to level 3, level 4. But I can't make the leap, and I'm an analyst first, to, okay, that means that when they're going after the ride-hailing business that Uber and Lyft and Didi control today, they can suddenly walk in and say, hey, we have these autonomous vehicles and you should use us, when there's going to be 10 other competitors who can do the same thing. And that's where people disagree with me. They say, well, there aren't going to be 10 other competitors. And I don't know the answer, so I'm not going to model into my price target. I can't see how Tesla's going to dominate that business. When I look at others' price targets that, without going into names, who are assuming, a $3,000 Tesla price target, and maybe half of it comes from robotaxi. I can't get there. I can't build a model that says, a demand model, not a supply model, a demand model that here's how big that business is, because a lot of people, are going to want to drive their own cars. Okay, but take the ride hailing and the ride share business, take a certain percentage of it, put a price per mile on it, give Tesla a share, put a margin on it, and a take rate that Tesla gets if they use their fleet, which is now over 2 million vehicles. I can't get a number that's anywhere near, we're talking about. So it may happen, but the way you should look at it is not that I'm being overly bearish. You should look at it as an option. It's a free option. I can get to $1,200 by putting no value on robotaxi. I put no value on insurance because they've struggled so far in California. Now they're going into Texas. I don't put much value on solar because they don't make money in it yet. I guess they will at some point. And all I need to get to $1,200 is they got to keep their share in EVs, and EV adoption has to go from where it is today to about 25% by 2025. And if I get that, I get a $1,200 price target. And I'd much rather be conservative than start throwing around numbers in robotaxi I can't justify.
Okay, that's fair. The other bear case that people tend to focus on, and there's a lot of questions is China. And I know you've done some work on China exporting to Europe. What's happening with the market over there, the competitors over there. So what do you think of China? What do you think your edge is there? What do you think that you understand better than the average analyst out on the street?
You can tell Dave was an analyst. This is what he does when he starts grilling management, which is what we do for a living. Look, I think there are a couple things going back to why were people so blown away by the China numbers? They shouldn't have been a surprise to anybody, right? Because you had third quarter numbers of 241.3. China had to be a strong quarter in order for them to get to those numbers, and they were. They had record for September. I guess where I am with China is there's two things. One, EV adoption was much higher than I thought, and then China deliveries were higher than I thought, but not by a lot. And so where I am with China is it's still the domestic numbers are still going to be driven until Berlin gets up and running by how much they export. And as far as I can tell, it's still going to be the first half of the quarter is going to be very export driven. And you're going to get a headline, probably November 9th saying China deliveries down 70%, 80%, whatever number it is. And at some point, you won't have that delivery wave anymore because you'll be making product in Berlin and you won't have to ship it. And all the Model Y, at least, will come back to China. So I think that the EV demand is strong. I think by introducing a cheaper Model Y in China is going to help dramatically. And I think at some point, people will stop reacting to headlines based on the month-to-month numbers where, again, the third month of the quarter is very strong and the first and second month are not as strong. And everybody writes these headlines that causes the stock to go down. So I think China it's now over 50% of the volume from quarter to quarter. Their share, if you look at just China domestic share, excluding exports, it was up to 18% in September. On a quarterly basis, it was 10-11, but that was artificially low because they shipped a record amount of exports out to the EU. Once those exports come back, you're going to see a much more stable China number, and I think they're going to be just fine. And I think that's going to continue to be a catalyst. And one thought that you left me with, Dave, is why has the stock gone up so much? One was China. One was that they seem to have dealt very adeptly with the chip shortage. One is just there's nothing else to buy. Okay, when you think about a large cap growth manager, 3% of their benchmark is Tesla. 37% is the big five: Apple, Microsoft, Amazon, Facebook, and Google. And other than Google, they're underweight all those stocks. So I think part of the reason a lot of portfolio managers have come back into Tesla in the last couple of weeks is the China numbers were strong. They seem to be navigating the the chip shortage, and there's really nothing else left to buy. And they're underweight a lot of those other names, with the exception of Google.
All right. We have some questions on Cybertruck. Obviously, a new form factor, pretty radical form factor, pretty radical materials, windows, stainless steel. So we've been delayed once, and now we're delayed again. And I know some of the configurations have been taken off the website. What are your thoughts there? Do you think they're going to lose first mover advantage versus the F-150? Give us your thoughts there.
Well, I'm waiting for a Cybertruck. I have a tri-motor on order. I'm one of the early ones, so I'm hopeful I'll get one, late next year, driving around Chicago. I'm not sure why it keeps getting delayed. I know there's, that Elon's talked about chips and in prioritizing chips for Model Y because you've got, back orders of Model Y in the US. There's 6 months back orders in China for Model Y that are 10 weeks. And I know he wants to use his chips to get Model Y, and that's probably smart. It's probably the smart strategy. I do think by having Rivian out and F-150 out early, that's going to benefit them, and it may hurt the folks at Tesla who, say, I'm not going to wait, 12 months and I don't know when it's coming. I think the pricing's too low. I think at some point we're going to hear that the pricing's up to 49 as an entry instead of 39, and my Troy motor will be 79. But I think, as we get into next year, we've got enough catalyst with, estimates going up, 2 factories coming on, the EV credit, there's a lot of catalysts that I think can get us through without having Cybertruck until we get to the second half. And so to answer your question, I'm disappointed, maybe even personally, but I do think it'll be fine. And most people have taken their Cybertruck volumes out of their estimates. Like I said, I have about 50,000 for next year's numbers, and I don't really expect them to do much next year in Cybertruck.
All right, a question about charging stations. Obviously, the more charging stations, the better. Tesla has essentially a closed network. They've been talking about opening it up. What are your thoughts there? Does that help the EV adoption? What do you think the strategy is there for Tesla in the big picture?
Yeah, this is a very divisive question. There's some that say keep it for the Tesla users only, and there are others like me who say no, open it up. I think they should open because it's free advertising. I think it's, you'll have billboards all over the charging stations that say Tesla. It'll give Tesla, people who don't own Teslas, a chance to see what they're missing. I think to your point, it does grow EV adoption. The more charging stations that are out there, the more likely it is people are going to buy an EV, period. And so I think if everybody knows there are charging stations everywhere, that EV adoption, which again, in the US, it's so low, it's like 3.5%, it could explode, and that's got to help Tesla. So I think the quicker they open up the charging stations, and I know Elon's on the same side of this argument, the better it is for EV adoption. And second, every single time somebody who owns a Mach-E or a Bolt or anything, hopefully they're not blowing up, they'll see what they're missing when there's Tesla ads and Tesla vehicles next to them.
We have a couple, short-term questions. One small controversy that's come up recently is Elon's options and how that would play out in the market. But also going along with that, the Solar City lawsuit. And do you think this is going to affect the stock at all? Do you have any opinion on how investors should look at it?
Yeah, on Elon's options, I think it's a non-event. I know some folks have made it a big event. I just don't see it. Activists buy shares in companies they're going after all the time. And, they get up to 5% of the float. And when they get done, pursuing it for whatever reason, they call up Goldman, they call up Morgan Stanley and say, hey, take my shares. I'll give you a 2 or 3% discount. You take the risk, and they blow it out. It's a block trade. And this is not a big number. It's a big number in terms of how much money Elon needs. But it's about, $10 billion in taxes at the current price. It's 22 million options. They strike at about 6.25, if I remember correctly. So if you apply a 53% tax rate, which Elon has talked about, it's about $10 billion. It's 11 million shares, which is about 1.4% of the float. And the stock trades, I don't know, 17, 18 million shares a day. So I don't know why it's a big deal. It's not dilutive, which is one of the reasons secondaries always make the stock go down, because you're basically adding more pieces to the pie. It's not, you've got dilutive shares, and that's what usually makes the stock go down. Yeah, there'll be a 1 or 2 day liquidity event because there's more supply for that day or two than demand. But after a day or two, it'll clear right up. So I just don't think it's that big of a deal. And the second thing is, who knows? Elon has a lot of margin he could call into. His stock is worth, I don't know, $150 billion. I don't know how much of he's used it, but if you got 50% margin, there's probably a lot of margin he could use to cover 10 billion. And I'm not saying he should do that. I just don't think selling 11 million shares is going to make one hell of a difference. After about a day or two. Is that your question? And what was the other piece?
Solar City. Solar City lawsuit.
I don't know. I have mixed opinions about this, right? If Elon loses, the shareholders get the money. On the other hand, it's bad press, so I hope he doesn't lose, because it goes to credibility of the CEO. So I think they presented a good case. I followed it for the first week or so, and then I kind of lost interest. It was kind of humorous to listen to some of the stuff, but I think at the end of the day, it's going to be a non-event. It's a one-time event. If he has to pay it, shareholders get the money. But I don't even know if he's going to lose. I don't think it's going to materially affect the stock.
Okay, and we have one final question, and it's it's short term but long term too. You talked about free cash flow generation. Obviously, the balance sheet has improved dramatically over the last year or so. But they're, Tesla's essentially capacity constrained, and they're bringing on some more capacity with Berlin. But will they have a global footprint, meaning India, UK, another China plant? So if you think about maybe the longer term, which obviously you have to have capacity brought on to grow your units 25 to 50%. What are your thoughts about their global footprint and kind of how that plays out over the next let's call it 3 to 5 years?
One of the best questions people could ask Tesla on the call. We don't know if Elon's going to even be on the call, but we could ask Zach. Is what are you going to do with all the cash? And to me, as a portfolio manager, institutional portfolio, that's probably the number one question I ask is, tell me about your capital policy, how you think about reinvesting cash. And there are a lot of really smart people on Twitter that have talked about this. And there's some of the street analysts have talked about it as well. But you want to look for companies where the marginal return on invested capital is higher than your cost of capital. And here, you can do some real simple math. You build a gigafactory that can produce 500,000 EVs in a year. Do some math, multiply times 50,000 ASP, 25% gross margin, take out appropriate level of SG&A and R&D, divide it by, let's call it $3 billion to build it, which might be high, but I think that's a fair price. You're getting about an 80% MROIC. And to me, they should be building as many as they can, because by 2025, I and a lot of folks are forecasting 5 million units a year. And today we're at, we're going to be 890. And next year maybe we'll be at 1.5. So they've got to build another, another 5 or 6 gigafactories after Berlin and Austin. So to me, that is their highest and best use of cash. Build more gigafactories. That's priority one. Priority two, and maybe it's priority one, is they got to get to investment grade, because you want to be in a situation where as you build the gigafactories, you don't have to go out and issue equity. You want an investment grade rating. It's hard to lose an investment grade rating once you get it. And it'd be very hard for Tesla users because they're spending out so much cash. Again, $10 billion of free cash flow a year after capital spending. So I would think the first priority is to get the debt down as low as possible, get the investment grade rating after fourth quarter, and then start building gigafactories. And that might be why Elon, when somebody asked him the question about gigafactories, he really didn't answer it directly, because he's trying to get that investment grade rate, which is the right thing to do. Get the interest rate down, get the beta down, get more funds that can own the stock. And then I would buy, 5 or 6 plants over the next 5 years. Where? Put another one in China, and maybe you dedicate it for the Tesla Compact, which is the Tesla Q. Then you have 2 in China. I would probably put another one in Europe, probably in the UK. So, different than the regular EU. I would probably put one in India, just because it's got, the second largest number of people after China. And I know that people say, well, they'll never make money. Who knows? There are a lot of affluent people in India. And when I do the math, I can justify a plant that could produce 500,000 EVs in India. So I would put those just as starters. And then, you could sprinkle the rest of them around. Maybe another one on the East Coast, maybe one in Central or South America. Mexico would be a good place. But I think the focus has to be that. I would not want them to pay a dividend because it locks them into it. Share buybacks, I like. Every institutional shareholder, I come from the institute, loves buybacks. They could do it opportunistically when they have a lot of cash. They can support the stock, when it's getting hit for inappropriate reasons. I certainly don't want them building up a big cash hoard. I certainly don't want them buying more Bitcoin.
Okay. All right, we're wrapped up with the questions. Any closing comments, Gary?
No, thank you very much for tuning in. If you think this is successful, let us know. We can do it again, and I appreciate all of your support. And let's hope Tesla keeps going up into earnings tomorrow. Thank you, everybody.